So in aggregate, our deposits have literally been stable.
So they haven't moved?
They have just hardly not moved.
Right.
Now, under the surface, obviously, there is movement because different customers, etc. So we have seen slight reduction in some areas, slight increases in other areas. But overall, it really has been incredibly steady. And I think that is part of the benefit of being very, very broadly geographically based. You know, we've got deposits across 59 countries. We have got no one country that is very significant in that. And actually, the sort of ebbs and flows we've seen with the client side have been steady, steady, steady.
As we talk more about the washout from banking turmoil, what do you think the impact is on net interest margins? Because there is a view that some banks, some lenders will have to pay more now to attract that business to pay up to keep deposits. Also question marks as to whether we're at the end point for a lot of the central banks on the terminal rate for interest rates and whether this is really now the best of it when it comes to those net interest margins. How would you assess the situation now on the back of banking turmoil and what it means for those banking margins?
So I think there are two things sort of mixed up in that. One is where governments will want to go with interest rates to get the right balance between economies sort of controlling inflation, and the other is the specific of whether we're going to have to, as banks, pay up to get customers to put deposits with us. I mean, I think on the latter, what we are tending to see is actually a flight to safety. People not so much saying, gosh, you've got to pay us more money for us to come to you, but people looking around and saying, where is an institution that has been around for many, many years, is trustworthy, is reliable, I will put them, my money, on deposit with those. So whilst there may be a little bit more pressure on the rates we pay, I think that is the bigger theme that we're seeing. On the first point, the question, which is the fine balance that many governments are struggling with, is just, is inflation getting tamed? What does one want to do with the rates? And obviously the markets are forecasting the rates coming down next year. Whether they'll come down quite as much as the market's forecasting at the moment, I think is debatable.
Andy, I'm going to pick you up on your let's split the Western markets from China. I think China's a much worse problem potentially as well. I think the local government debt problem is enormous. I think you've got an economy which is supposed to be opening up, and yet they were cutting triple R's as late as March or February, I think it was as well. So if things are so great in China, why is the PBOC so incredibly dovish?
So I'm talking about the West and the East. Yeah. Generally, and not specific to one country.
China's got to be the
China is a very big part of it. But we are seeing, particularly with our business, and remember our business is very much about import-export. We are not a domestic bank in China. We are much more a facilitator of import-export activity. And that has been very strong. And in fact, over the last year or so, when the overall GDP growth in China was low, we were still printing double-digit growth in the activity we've got there. We've got the Chinese government very, very keen to make the renminbi a bigger part of the global currency pool. That is exactly what we specialise in. The intra-Asia trade activity, we are in almost every Asia country. So even if there's a bit of a shift from China to other places, we are on both ends usually of that trade.
But I mean, I'm just looking at, well, let's look holistically then, rather than just at domestic China. Things aren't working. Why is the oil price at $80? Why is the copper price trading, at multi-month lows? Why is iron ore coming off as well? If things were looking great on, you talk about the import and export in China, I don't understand why these key markers are not showing greater resilience.
Well, I think individual commodities have got individual sort of demand-supply factors that are coming with them.
I'm talking about the big three for the Chinese economy: copper, iron, and oil.
Yeah. But I mean, I just say, look at the numbers we are printing. Over the last 3 or 4 years, we have consistently had good growth in China.
Fair enough.
So even though China itself may have some ups and downs, the activity that we have got there is genuinely, evidentially, is picking up a bit by bit as we go through.
Tell us about the property exposure then, because obviously you had to provision, I think, in 2022, quite a significant chunk, and a lot of that was around China property debt. Where are you on that story? Have you run down your exposure? And how are you working with the government or regional authorities to make sure that it doesn't blow up?
Yeah. So just context, not lots of numbers, but our total loans and advances, $300 billion. The proportion of that is China commercial real estate, 3. So firstly, it's 1% of our total. Of that 3, we'd reserved at the end of last year about a third. We have not taken any further significant top-up charges. So at the end of December, end of March, we have seen the situation broadly stabilise. So we are comfortable where it's at. And actually, one of the features of our results this quarter is how low our credit impairment charges were. So on a $300 billion loan book, our total credit impairment charges were only 26 million. That is one of the lowest we have had for a very long time. So the quality of the underlying book is really strong. Where we have had some exposures, sovereigns has been one, China commercial real estate the other. We are very happy that those are settled. That's not to say that they can't move a bit more, but we think they are marked in roughly the right place.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.